David Boy here. I own Black Diamond Mortgage, and this is intended to provide you good information on how mortgage companies approve borrowers who are self-employed. And the idea is if you don't get anything out of anything that goes on here after this moment, the email that you got has everything in it. And important in there is links to a lot of the things that I'm talking about. So one of the things I wanted you to get out of this was the ability to go back and figure it out later. So if we talk about something and you forget all about it, the intent is that you can go back to that email, just click on a link and go find what we were talking about and get the answer. And then if it's beyond your ability, anytime you can reach out to Black Diamond Mortgage and we'd be happy to answer the question. So with that, I wanted just to quickly thank Mark Beck and the RE/MAX real estate team at Glacier Country here in Kalispell providing the facility. They got a great team of realtors there. And as this whole thing's going on, Maria at blackdiamondmortgage.com, so Maria's our operations manager, she would have emailed you a packet. And if you're watching this and you think of something, you can actually shoot an email to Maria. You can chat on the Facebook group, and you can just reach out to us any way you can, and we can actually try to interact with you during this presentation. And so Zach or Maria might run up to me and hand me a question, and that's how you do the question. If you're here live and you want to raise your hand, what I'd actually prefer is if you write your question on one of those little Black Diamond Mortgage notepads. And I do want to get your questions and I do want to answer them, but it'll be a little bit better for the presentation if I kind of see what it is and address it at a certain time. So as we're going, if you get a question, raise your hand or message it, and then it'll get to me, and then I'll either answer them at the end or in the middle of what I'm talking about. Make sense? So with that, wanted to real quickly plug the next class that's going to be happening. So this format is something Black Diamond's going to be doing for a year. And we'll see how it goes. We're going to try to do 12 of these, one a month. And so the next one is going to be how to go from $0 to millions of dollars in real estate wealth. And that's going to be in January. So if you like this class, there's going to be that one. That's going to be geared for people who want to do that. And we're just going to be providing the toolkit on somebody that wants to go from never owning any real estate to owning millions of dollars in real estate, and how you use lending to get there. And so there's a great playbook, and I want to present it to realtors and borrowers and anybody who has an interest in it. And it's going to help you master using less cash to build that wealth, and what you can do with what you currently earn and those kind of things. So that's going to be in January. Any feedback from this class, provide it to me so we can make it even better in January. All this content will also be stored on the Black Diamond Mortgage webpage, so reach out there anytime you want. So in your guys' packet, there was a tax return. So I don't know if any of you guys can grab that, or if you're online, go to your email and open up your email and look throughout the email for the tax return that's in there. And this is kind of a trick question, but I want to see how everybody does. So there's a tax return in the email or in your packet for Joe B. taxpayer, which is Joe Blow. And I want to get some feedback from everybody here, but I'm just going to point out to everybody here that Joe Blow's tax return shows on line 15 of the year 2020 that his net taxable income is $1,740,800. So what I was just kind of curious, and I guess people here in the room can answer, or can this guy get a loan for $300,000? Anybody want to take a stab at it? What's that? No? And everybody's scared to death to answer. Anybody want to take a stab at it? Can Joe B. taxpayer, Joe Blow, get a loan with? He wants to borrow $300,000, and he currently, on his tax return from 2020, he has a net taxable income of $1,740,800. Can a bank loan him $300,000?
Not if he has a lot of debt.
Not if he has a lot of debt. Okay, that's an answer. Anybody else?
Not if he has a new business.
Not if he has a new, did you look ahead? Oh. Not if he has a new business. That's a good answer. Anybody else? Okay. Well, the answer is that we have no idea whether he can pay back $300,000. And the reason is this was his year 2020. And although he did make $1,740,800, he may have spent it all already. And we have no idea what he's making right now. So this is a common thing is if you work at a mortgage office, somebody's going to throw a tax return at you and go, look at me, I'm awesome, give me a loan. And they do. I mean, my first reaction as a loan officer when I see this is going to be to get excited and go, this guy makes good money. But we don't really know what he makes right now. So what we're going to do real quick is I'm going to give you the single most important thing to know when it comes to taking a look at a self-employed borrower or any borrower for that matter when it comes to getting a mortgage. So pretty much everything in lending comes down to this one single principle. And the principle is the person likely, based on the lender or the underwriter's analysis, to be able to make their payments for the next 3 years? And so when a loan is deemed to be approved, the standard is, can this person do what they need to do to make the mortgage payment for the next 3 years? So as we're looking at any of the documents that are provided to us, what the underwriter is doing is trying to make that decision. And to give you a little inside baseball real quick, in lending, loans are generally deemed to be good if the borrower can pay them for 3 years. So like say for example, you take out a 30-year mortgage and nobody knows what's going to happen 30 years from now. But it's deemed to be acceptable in the industry that if we think the borrower can make 3 years worth of payments, they can figure it out. So the lenders actually don't even care what happens after year 3. And we even have loan analyses where if the borrower can receive a type of income for 37 months, we'll give them a 30-year mortgage based on that because we assume if they can make their payment for 3 years, they're good. So that's an important principle when looking at self-employed borrowers. So on that tax return, there was a lot of information, a lot of income, but the answer is we don't know, which is going to get at the next most important thing about analyzing income on tax returns or just borrower income in general. And that is that each source of income is completely individually analyzed. So if they have a whole bunch of different kinds of income, you have to look at each one individually to determine how much money they make. So easy example would be is if you own 2 businesses and one business makes $1 million a year and the other one loses $1 million a year, then you make 0 because one's making $1 million, the other one's losing $1 million. So just the existence of one business that's doing well doesn't mean you're qualified. So when you're looking at a tax return, you're first trying to figure out how many sources of income are there. Is there just one or is there 2? So for a lot of people, and actually Joe Blow, taxpayer, he has, if you flip to the second page, he owns a business building. He has a Schedule E form. And so that's part of his income or loss. And so when you calculate his income, you have to take a look at the building that he owns and determine if he is making money on the building or if that building is a cost to him. And so that's one piece of Joe's income. And then on Schedule E, the other part, you'll see there's a couple businesses listed. So this is Schedule E, page 2. It's a fairly important page for looking at a self-employed borrower's tax return. You'll see there that Joe has line A, which is Joe's business that closed at the end of the year, which would probably have a name in real life. So that business actually doesn't even matter for looking at this guy's loan because it closed. And that was in the year 2020. We're way down the line in 2020. We're literally just going to take that one and just put it off to the side. And then you see that he has Joe's started a new business in the last 3 months. So that's the one that we could look at because at least it's open. Does anybody want to guess what the problem with that business is, though, just off the top of their head? 3 months. Yeah, it's not very much time to figure things out. So He made $1,500,000 though, so that was pretty good. So there might be a chance to help him. But unfortunately, when you look at Joe's tax return, he made $1,700,000 in the year 2020 and reported it to the IRS. But $1,500,000 of his income came from a business that's only been producing profit for 3 months. So that's his big challenge. So on the one hand, he's got a great looking tax return as far as he pays taxes and he tells the IRS he makes money. On the other hand, he's got issues, and the big issue is getting back to that thing I mentioned, which was the 3-year continuance of income. And so that's where the loans live or die in self-employed, is whether the underwriter can decide, or the lender looking at the underwriter's findings, if this person's income is going to survive the 3-year period of time that makes the loan good. So how do we do that? So that gets on to a couple different things, but I'll first mention, and some of these things are in your packet. I might jump around, as I tend to do that. The old school standards, what we'll go over first, and then we'll go over cool ways to beat the old school standard. So the old school standard is if you go into any bank or basically look up the guidelines for any loan program, they're going to say if you're self-employed, you've probably heard you have to have 2 years experience to get qualifying income for a loan. And the idea behind that is if you're making widgets and you're making a profit, if you did it for 2 years and made a profit, then that might be deemed that most lenders will be like, okay, probably could do it 3 years into the future. And that's where that comes from, is if you did it twice, probably do it again. And they have a few other tests that they apply to figure that out. So when we're looking at Joe Blow, taxpayer, his problem is he's got that 3-month thing where he made a lot of money, but he doesn't have very much history. If a lender was even going to consider giving him a loan, what they'd have to do is they'd have to figure out if that $1,500,000 income he made in 3 months was any indication of him doing it longer, and they'd probably have to make an exception to their own guidelines to give him some credit for that to move forward. We can go over some examples where they might do something like that. Typically, they're going to say, no, let's wait until he files one more tax return, because that's not something we're sure is going to happen again until we see it happen again. And so that's the old school standard is 2 years history equals 3 years of continuance into the future. When you're looking at that, there's a couple things, and I have in your packet, there's a couple things you can do, but there's this thing called a cash flow analysis. And that is in your packet, and the reason is so if you ever want to know what do they look at to add income or subtract income, typically what a lender or an underwriter is going to do is they're going to take the information that they're looking at on the tax return, and they're going to go through this worksheet, and they're going to determine if there's anything that they can add back to the income or take away from the income. So each individual income, so we have business A, B, however many businesses they own, we're looking at them as, how much money did they make, and then did they, examples of things that are easy to add back to the income are like if you bought a vehicle that you wrote off the entire vehicle expense, there's a deduction called the Section 179 deduction where you can buy a sport utility vehicle or truck and you can write the entire expenditure off as the owner of a business. So it might make you look like you made less money, but we will add that back because that's not like considered a cash flow loss to the business. And then other things they look at are like depreciation of assets. So generally speaking, with depreciation of assets, if the asset's going to depreciate over a period of time, say 5 years or more, then that is deemed not to be a real expense to the business. It's just something they can do for tax benefits. So those things can be added back to their income. So they go through the cash flow analysis and you look at those types of things. There's one on there on certain types of borrowers, and they can look at the use of their home. And if they're writing off a lot of use of the home, sometimes that can be added back to their income. And there's amortization, and there's what we call one-time expenditures. Those are really handy. So if a person has something that they're going to do a huge expense one time, but we can clearly see that it's not something that's going to happen every year, then we might be able to add that back to their income. So we use these worksheets, and we use the tax returns, and we develop a income for the business based on looking at the tax return and then applying the worksheet, and the net off of the worksheet applies to each individual business that they own. And then we do the same thing with the real estate that they own. So if you own an office building, then we would potentially look at that and determine if there was so an example would be is you had an office building, and right when you bought it, you bought a new furnace for $25,000, and it's going to last like 25 years, and that was something you bought, and you somehow were able to write the whole thing off, which normally it might not look like that. But if you did write the whole thing off, then we might add that back and say, well, that's a one-time expenditure. So we would look at the net after adding that back. And so we look at each property, and after we look at each property and each business, we determine what the borrower makes. And then we apply that 3-year sustainability test to each item. And then a common thing that will happen, and I'll point it out, is if we want to look back at the front of Joe Blow's tax return, he makes $75,000 in W-2 wages. And a common thing is people will say, well, I got this W-2 wage, and that's not self-employed, or that's extra income for me, and that type of thing. What we do is when we're looking at the business, the W-2 is just added to the bottom line for each business, and it's not looked at like a separate form of income. So if I own Black Diamond Mortgage and I pay myself a W-2, and then I also get the profit from the business, then I get the W-2 plus the profit. They're not looked at separately. And then also, if I started my business 3 months ago and I start writing myself a paycheck through a W-2, it's not any more reliable than the profit from the business. So W-2s from your own business that you own are the same as your self-employed income. And then if you happen to have W-2s from other reliable jobs, those can help you qualify with more income. So that's kind of the gist of how we go about approving self-employed borrowers. Is we're going to look at each line item individually. We're trying to make a decision about whether this loan can survive 3 years into the future. And often we're looking 2 years back into the past to make that conclusion. And then we're looking at each thing separately and then adding up the net of them all. And we're excluding anything that isn't going to be around anymore. And so all those things in total make up the borrower's big picture. Number one thing is do not rely on the net taxable income from the tax return, because that number is just happens to be a moment in time for the IRS. It's not necessarily what we're going to look at as reliable. So now that's where you tend to hear people say if you go into business, you can't get a loan for 2 years. Is commonly people say that. It's not necessarily true, and we'll get into some ways around that or ways to make a better situation. But the safest thing to know about whether you can get a loan is that's how it is 2 tax returns equals stability, and lenders are going to deem that to be good income for the future. Things that tend to make that harder are, let's say in year number 1 you make $1 million, and then year number 2 you make $500,000. Now the lender's scared of your loan because you made $1 million 1 year and now you just lost half your income. The fear is it's going to keep going down. So declining income is scary to lenders, and as a general principle, they don't like to see more than a 20% or 25% drop before they panic and just say they want to wait 1 more year. So declining income can be rough. Increasing income they like. So if everything's going up, then they have a totally different opinion about it. They also do this thing so we have a couple accountants watching, and in the past, mortgage guys and gals were calling accountants and saying, give me a letter saying that you think this guy is going to do well in the future. And the accountants are like, no, I'm not going to write that letter. I have no idea what this guy does when he's outside of my office. But the lender's like, well, we can't tell how he's doing right now because it's been 18 months since the last time he reported anything to the IRS. We need what we call a comfort letter. So those have kind of started to go away because the organization that CPAs subscribe to is like, don't write these letters telling all their accounts. So the ones that would write them would typically write, yeah, Joe Blow tax player, he's great. If you look at his tax returns, he looks like he's making a good living. Although I haven't seen anything recently, I have no idea what he's doing. Here's a letter from a CPA. So sometimes we can get those because then the CPA is like, I didn't really say anything in the letter. But generally they don't want to write the letter. So currently they're kind of taking a different approach. And the different approach is to look at the bank statements of the business. And so coronavirus kind of caused this. But we had businesses that literally just shut their doors for 3 months, and then their last tax return was from 2019 and looked great. And then they're in the mortgage office in August of 2020 after being closed for 4 months, and we're supposed to decide if they can pay a loan back. And the honest answer is like, I mean, how do you know, right? So we would normally in the past, we'd be like, hey, well, how about we call the accountant and see if he'll stand up for the guy? And of course, they're not going to because they're like, I don't know. And he's got a PPP loan, and that's how he kept his doors open, So what we're doing right now, and that's probably going to be kind of what's going to be going on for a while in the future, is we will look at the business's bank statements, and we're going to look and see if we see money moving around. So as a general principle, you're going to have your tax return history that's going to say, okay, it looks like they make money, they report this income to the IRS. We're going to look at the most recent bank statements and see that you're making deposits. Now, I'll give you an example of a cool one that we did during the coronavirus, because this is kind of like in both universes of got a problem and we have a solution. So we had a realtor that was getting turned down by an online lender, and the reason was because they did this bank statement analysis and they hadn't made any deposits, and it was June, and it was right after coronavirus. So they made good money in 2019, but here we are in 2020, and their bank doesn't show a lot of deposits. And the lender is skeptical about whether they're going to be able to make real estate sales right away after all the drama. It turns out if we'd all known what was going to happen, we wouldn't have been scared of right after the coronavirus. But at the time, everybody was scared. Maybe nobody's going to be able to sell real estate. So we had to come up with a solution. Luckily, in this borrower's case, they tended to specialize in new construction real estate. And so what we ended up doing is they didn't have the deposits, and the lender was like, okay, that's a big deal. You need those deposits. We need to see commission checks going into the borrower's bank account to prove that they're making real estate sales. What we did is we showed in the prior 2 years they did new build, and they tended to get paid in the second half of the year, which was actually true in this borrower's case. And then we just showed that they had a couple of these contracts active. And as soon as these houses were built, they were probably going to get sold, and they were probably going to be depositing a real estate commission for a profit. And so in that case, we were able to not have the money in the bank statements. They had a good year in 2019. We had this problem called the coronavirus, and we needed a solution. Getting back to what we said at the beginning, the lender's got one concern. Will this person be able to make their payments for the next 3 years? And so if there's a problem, you got to find a solution. But important thing is, in addition to looking at the 2-year tax return analysis, we're going to look at the current situation through the business bank statements to see that there's money moving. If there's no money moving, it doesn't necessarily mean you're not going to get the loan, but there's going to have to be a solution to that problem, an explanation that makes sense to the underwriter. Another thing we look at that is important is if say you have a business and you're going to do something that a lot of people are doing in Montana, is you're going to pick up from California and you're going to land in Montana, and you own a business in California. Is that a good move for a lender to give you a loan when you land in Montana? I don't know, right? So what would make it a good move is the lender needs to take a look at this business and say, is it likely that this income can be earned now that they just picked up and moved from California to Montana? So there are different scenarios, but I've had borrowers that they can do it. An example would be I had like an attorney one time, and he was moving from one state into Montana, and his primary clients were these corporate clients. He had like 3 of them. He didn't really have to visit them very much, and he could literally work anywhere in the United States. But he was moving. So what we did is we had one of the clients or 2 of them write a letter just saying, hey, just so you know, we're going to keep using this guy as our attorney when he moves to Montana. So he's moving his business all the way across the country, but we were able to see that he can continue doing what he's doing, and we're okay with it. Where we're going to have a problem with it is you're running a donut store that's on a corner in somewhere in Oregon or California, and then you're going to come here and open up a donut. You're going to close that one, and you're going to open up the donut store here in Montana. Nobody knows how that's going to go. That's going to go to the 2-year tax return standard because we got to wait and see how it goes. So they're going to look at moving the business as a big deal. And then they are going to look at the financial strength of the business in general. So one thing that we do, I don't think I included this in your packet because I didn't want to get too wonky, but we are going to kind of look at the balance sheet of the business if they have one of those tax returns that shows that. So an example would be is a S corporation, which is common for a lot of businesses. They will have the income from the business, and then they will also have a balance sheet within the tax return. And in there is little nuggets of information that the lender can look at to see if this business looks financially viable. And things you might see in there are big loans that are needing to be paid that might not show up on their credit report. There's this one thing that we look at called notes payable in 1 year. So a lot of times people have like a large line of credit, and the bank renews that line of credit annually. And so it's on there as like maybe they owe like $300,000 by the end of the year according to the tax return. A lot of times we can solve that. We'll call the bank and just say, hey, what's the plan with this loan? A lot of times the bank will say, we renew that loan every year. It's really not a problem for us. In that case, we'll be like, okay, so they're not going to have to come up with this money that they owe at the end of the year. But it's on the tax return. It says note payable in 1 year. If it's truly due in a year, we need to see if they have that kind of money in the bank, which is tough for a lot of borrowers. So we do look at the balance sheet, and we look at the liabilities that show up in the business that don't show up on the borrower's credit report, and we use that as a means to determine if they're likely to survive the 3-year period that follows the issuance of the loan. Another thing you're going to see sometimes, some borrowers have this, is they have things like guaranteed payments to the shareholders. And so there's like, you got your whole business, it's got income and expenses, and there's a net income for the business. And then all of a sudden there's just like, regardless of what happens at this business, we guarantee we're going to pay the owner, $200,000 a year or something like that. Sometimes we can use that to overcome the business not looking like it's making very much money, as long as we think as a lender that they can do that financially, even though the business doesn't look like it's making a ton of money. So sometimes it's not acceptable and sometimes it is. But it's sometimes a way where the borrower might have low income from the business, but they're getting a guaranteed payment through some agreement they made. And if that guaranteed payment can survive and looks likely to survive, then maybe that can be used as income for the borrower, which can help because they might be paying less taxes by not having profit from the business. So that is something we see. Okay, this is a big deal. This comes up a lot. So 25% ownership is a different bucket than less than 25% ownership. So if a business is, if you own 5% of a business, we deem you not to have a ton of control over that business. So we're going to be less scrupulous in analyzing the income. If there's a little bit of income, we're probably just going to take the one little statement you get K1 and call that the income and be good with it. Whereas if you're the owner of the business of more than 25%, we're going to really analyze it because you have a lot of control over that business. So you'll see sometimes like doctors and other professionals that might be in a large entity where there's lots of owners, and they might only own 2 to 3% of the business, and they're making good money, but we don't have to analyze their income as we would a typical self-employed borrower, because they don't have a lot of control over the business other than they just get their 3% share. If they look like they're making good money, it's easier for them to get the loan than the one who owns 25% or more. So that's a big deal in looking at self-employed borrowers. All right, now here's something that comes up a lot, and we get a lot of questions about it, but it's called the tax transcripts. So what happens is you file your tax return with the IRS, and then you walk it into the mortgage company, and you go, here, I filed this with the IRS. It says I make $1.7 million. How are we looking? And you would think that we would just get excited about the 1.7, but as we talk, we're going to analyze it. But let's say everything's great, and it's a great looking tax return, and we take one extra step, and we actually reach out to the IRS and have them send us a transcript of what you filed at the IRS. The reason is because people lie and they commit fraud all the time. So I don't know if you know this, but people aren't honest. Some. And so it happens enough that it turns out that a borrower can just walk into a mortgage company, prepare their own tax return. In fact, I actually went on to the Google and typed in 1040, and I filled this thing out. So I could, if I was wanting to commit mortgage fraud, I could fill out one of these tax returns and walk it into a mortgage company and go, that's how much money I make, and it might look great, and if I didn't find any problems through all the other analysis that we do, we might get all excited to give them a loan. But what if they never actually filed that with the IRS and it was completely made up? So the transcript is how we test that. So we reach out to the IRS. They've got an automated system. Everybody hates it because there's no one there. But you go through their steps and you get your transcript. And then we look at the transcript and we look at the tax return and we go, hey, do these things match? And if they match, then it's a good tax return. And if they don't match, we got to reconcile the discrepancy. And so that can be an issue for borrowers who file amendments. Sometimes you file your first tax return, and the accountant receives new information that's going to better the borrower's situation or make it worse, and an amendment gets filed to correct that. And when that happens, the transcripts might get a little held up down at the IRS because they also are like, hey, what's going on? They might choose not to release the transcript. The borrower may owe more money now, and so sometimes the IRS will actually use the owing of taxes as a way to hold the transcript hostage. Because if a guy's out trying to get a loan and he can get that loan, then maybe at that time the IRS wants the taxes all paid so they can release the transcript. So they actually do that at the IRS. If the taxes aren't in some kind of a payment agreement or paid, they won't release the transcripts to us, and that's one way they collect money. But anyway, we use it as a validation tool. If we can't validate it because the borrower has a good excuse, we have one other tool, and the other tool is the payment. So in other words, if you file a tax return and it says you owe $50,000 to the IRS, and we can't get the transcript to come through because there's a problem. There's a lot of reasons why the website doesn't work. There have been times when the IRS is just like, hey, we're down, and everybody's like, I'm trying to get a loan right now. So it's like, what do we do? The solution can be in the payment. So if they owed $50,000 and they paid the $50,000, as a lender, we look at that as proof that you probably filed it. Because why would you send the IRS $50,000 and we could validate the money going through the IRS, and then you didn't file that tax return that said $50,000 on it? So transcript or payment are usually sufficient for us to believe that the tax return actually happened. Another cool thing is, so there's a lot of stuff we talked about that you have to do to demonstrate that you can get a mortgage with a self-employed borrower. There's a few exceptions that are granted, and one of them is if you're putting a decent down payment down and you use your own money for that down payment, there's a chance that you'll have to do less scrutiny on the tax return analysis because your ability to make the down payment with your own money and not rely on the business to do it makes the lender feel comfortable that they don't have to analyze the business so much. So if you're sitting on a bunch of money and you're getting a rough time in underwriting with a lender, and that's your money, you might be able to get a little grace on underwriting analysis because the fact that you can make, say, like a $100,000 down payment or something like that adds strength to your loan application, and it allows the lender to do a little bit less of the digging that they normally do. All right, so that's the old school. Let's get into cool stuff, okay? So the worst case scenario is you got to have 2 years of taxes. Everything's individually analyzed, and we're looking to see if it's likely to go on for 3 years into the future in order for it to count. And then we're looking at each income individually, and we don't look at the net taxable income, and that's the generic standard. Now, how do you get opportunities? So opportunities are, so most of the loans that get originated that people want, where they want the good 2% money or the 3% money, is coming from Fannie Mae, Freddie Mac, VA, or FHA. That's usually where the money's coming from. So those rules are established. And as I mentioned at the beginning of the class, the link to these entities and all of their rules is in your email. So if you're ever just staring at a situation, like, I don't remember anything Dave said, I think this guy says he's getting a Fannie Mae loan, I'm trying to answer this one question for him because I'm the accountant or I'm the realtor and this lender's dropping the ball and I want to see if I can solve it. Just click the link, pull up the rules yourself, you'll see all the rules right there. So one cool rule that Fannie Mae and Freddie Mac are doing right now, and these things change, but they've been doing this for quite a while, is if your business has been around for 5 years, then we can just get by with 1 year of tax returns instead of 2. This is a really big opportunity for a lot of borrowers because there are borrowers out there who have fluctuating income. And when I mentioned a few minutes ago that if your income fluctuates too much, they might not be comfortable with your loan. So take an example that I mentioned earlier, the person made $1 million 1 year and then they made $500,000 the next year. $500,000 would normally qualify them, but it's a 50% drop in income over the year before. The 2-year tax return analysis is going to nuke that person's loan. But if they've been in business for 5 years, then they'll be happy with 1 year of tax return. So if they're looking at 2, they're going to decline it. If they take the 1 year exception, the loan's approved because they have a history of being in business for over 5 years. So that's an exception, and it's a good one. I had a borrower that had this situation where they have this product that they invented, and they'll spend like $1 million getting it out to market, and then they make millions of dollars when they sell it. Well, in one of the years, all they did was invest in the development of the product, and then the next year they were making millions of dollars. The 2-year tax return just totally nukes it because it's just like you go from millions to zero, and there's too big of a discrepancy for the underwriter to handle. But because the business has been in existence for 5 years, we could just go with the 1. And this borrower actually had their loan in a scenario where it was getting declined on the 2-year basis with another lender, and it was able to be dug out and closed by just switching that and just kind of getting that exception that's allowed. So that happens. So there are people out there, a lot of times people that go online to get their loans, this is where they run into trouble, is they need somebody to actually step back and think about it, and there's exceptions available. So that's a fun one. I think we talked about a few of these other ones, so I'm going to jump ahead. So underwriter discretion is where the fun is as a mortgage company. It's where Black Diamond Mortgage has had a lot of success. So there's the rules, and then if you read the rules, and we're not going to read them right now, but if you were to go on to Fannie Mae or Freddie Mac or VA, you kind of have your standard set of rules, and then every one of the rules has like built into it, if the underwriter deems that there to be a good reason to make an exception, they can. So the question would be, well, what makes them make the exception or not make the exception? It goes back to that 3-year continuance issue. But if people believe in the loan and they can come up with a good reason for why this person can't do the 2-year tax return, there's usually an exception available. I'll give you a couple examples. I had a veterinarian one time that was getting into a veterinary practice, and they were buying into this veterinary practice. They had been to veterinary school, and immediately upon walking in the door, they were making enough money to qualify for a mortgage, but they didn't have 2 years because they just bought in. They went from being an employee while they were in college to being an owner once they completed all their certifications and whatnot. If you read the guidelines, it's pretty clear that once you buy a business, it's 2 years. So they're not going to get the 1-year exception by being in business for 5 years. Have been in business a short period of time. The rules are stable, but there's a discretion area in there. Well, what we were able to do for this borrower is the way that they were getting paid was the same every month, basically, and it was good income. And the lender was able to make an exception and say that we'll back this loan. What typically happens when the lender does that is if it's wrong, let's say they give out a $300,000 loan to somebody and they make an exception. Fannie Mae or Freddie Mac might say, okay, fine, here's your money at 2.875%, you can give it to the borrower. If anything goes wrong in the first 12 months, we want the money back. So the lender has to make the call. Am I willing to do that for this borrower or not? Sometimes they will. And so if it makes sense, the lender might just say, we're going to fund this loan. What happens is the loan closes, it's fine. If everything goes the way that it was presented, then it's okay. If there's a problem, it falls back on the lender as having made an exception that was inappropriate. So lenders don't want to give the money back if they got it, but they can. So underwriter discretion is a huge opportunity. There are lots of scenarios that come up where the borrower is able to demonstrate a likelihood of going 3 years safely into the future, but doesn't have the 2-year history. Other things we can do is if the borrower has a lot of assets, then that provides a lot of opportunity to do things. So if a person's pretty wealthy and they don't make any money on their tax returns, we might even actually be able to just look at their wealth and deem their ability to make a payment off the wealth. And so that you could have a person that's their accountant's doing a fantastic job. They don't look like they make any money. They got $3 million in the bank, but they don't look like they make any money. We can do things where sometimes we can take their available assets and we can just divide those assets over 3 years into the future. And if it looks like they would be able to make all the payments for the next 3 years, we would use that as a qualifying basis instead of their tax returns. So that's an opportunity. It requires discretion from the underwriter. Other things that are exceptions are liabilities that are paid by other people. So sometimes you have a business that's got something on there and somebody else is making the payment, or it's reducing the income of the business, but we can show that the payment's not actually affecting the business. Another example would be we do look at what shows up on the borrower's credit report. And sometimes if the business is paying that, we can add it back to their loan application. So the point would be if a liability is showing up and it's harming a borrower's income, it's in the expenses of the business. Sometimes we can look at the net income of the business and then remove it from the calculation that comes off their credit report and help the borrower look like they're doing better by proving that the business always pays that loan for the borrower. One thing that tends to come up on that particular one is which bank account they make the payment out of. So Montana is classic for people that just kind of they're independent and they don't like to do their paperwork the right way. But a good strategy is if you got a business and you run everything through the business, and then your personal bank account is your personal stuff. When we do these type of things, we're like, oh, so you always pay that through the business, then it should be coming out of the business bank account is better than if it's coming out of your personal account. But that's an opportunity. Let's say you're in one of these occupations where you buy a business or you're getting into a business and it's just not going to look like it's making any money for a while. A good example would be a construction contractor. They might be making good money, but let's say they happen to open up their own business and they get a truck and a ladder and a tool belt and they immediately go into business and they don't look like they're making very good money. But before they did that, they were making $100,000 a year working for one of the local construction companies. And now they want to buy a house. A lot of these guys that look like that are getting 1099 from a business that they used to work for, and they made a deal where they were going to now be on their own. And maybe the construction company liked it better because they get rid of the work comp and all this stuff. But now they're going to buy a house, and they used to look like they made $100,000 a year. Now they don't look like they're doing as well. If they go back to work for the guy, they can immediately look good again. So people that want to go into self-employed and then they go in to buy the house and the bank's like, it's not like, well, if they go back to work for somebody, that could immediately make them qualifying, because when they have a job with a stable employer, we're not doing the 2-year analysis thing. So if the 2-year analysis thing is killing you, or you're entering the workforce and you're going to be like, no one can determine if you can make a living or not, and there's a job out there that you could work for a period of time long enough to get a mortgage, sometimes that's a good strategy. Go buy the house, go back to self-employed shortly thereafter, and it's a workaround. And we see a lot of people doing that. They're working for somebody, they switch them to the 1099, now they're self-employed, and then now they can't get a mortgage because they needed like 2-year experience. The person that they make all their income from probably would hire them back. The quick way to buy the house is to get hired back and then maybe go back to self-employed later. Let's say none of that stuff works and we've worked over your taxes, and we can't get exceptions on the 1 year, just not looking right, but you know you can make a mortgage payment and you can't prove it to us. And you still want to buy a house. We're not dead yet. There's still opportunities. So if you're self-employed and you just don't show it on the tax return, and alternative products are currently in existence in the marketplace. They're better than the ones that were before the last housing crisis. Basically what they do is they pick 2 options and they have to qualify on these 2 options. So they can do a no tax return loan where they say, we're not going to look at the borrower's tax returns. Not going to look at them. Then we have to look at something else, because when the housing industry crashed, they said you had to qualify the borrower somehow. And so if you say, well, I'm not going to look at the tax return, well, then you have to look at something else. So you can look at the bank statements, and you can say this loan is based entirely on the bank statements. And so that's called a bank statement loan, and it's basically for borrowers who, for whatever reason, don't want to get a loan based on their tax return. And so the bank statement loan, we're going to gather the bank statements for either 12 or 24 months, and we're going to work up a cash flow plan that looks like a realistic, how much money can this person extract out of this business, solely looking at the bank statements. And if they can do it, they can get a loan. The primary difference between those loans and the other 80% of loans in the universe that are the way that we talked about at the beginning of the class is the down payment. They tend to be 20% to 25% down. You can't get like mortgage insurance on these. So if you can make a down payment and you can't produce a decent tax return, there's a bank statement loan. And then there's another one, it's got an acronym, it's called DSCR. But essentially what it is the property pays for itself. And these are allowed because the borrower is not the reason that the lender thinks that the loan can get paid back. They're not regulated by the stuff that came out in 2008, Dodd-Frank and all that. They're literally just looking at the property. So this tends to work great for people that want to do like VRBOs, or they want to buy rental properties, and they just don't have whatever they need to qualify. The lender is going to basically determine what the property can rent for, and then they're going to take a look at the mortgage payment, and if the rent payment is equal to or higher than the mortgage payment by a certain amount, then they can go, well, if this borrower doesn't pay, we can just go into this market, take the house from the borrower, and we can get rent. So we're going to call it qualified based on the rent, not on the borrower. So these are tend to be focused on investors, but you can use it for basically any purchase of a home to buy a home. And again, it's 20 to 25% down, but it eliminates everything that we talked about in this class, and it just comes down to the property and what it can rent for. And so that's another workaround. Okay, I've talked a bunch and I haven't seen any questions, so I'm going to give a couple chances. Is there any questions? Maria's got them all written down there. Okay, I'm going to take these, and then just to remind, everything that I've mentioned here is in the content, so you can go dig it up yourself. And you can also reach out to us and ask anytime. All right, I'm going to pick one at random. I don't know what these are all good, right? Okay. I'm working with a self-employed client. What questions should I ask to understand if they'll be able to afford a mortgage? So I guess going to what we just talked about, how long have they been in business is a good one. Actually, a better thing was if they haven't completely jumped off the bridge into self-employment, what I like people to do is to think about going into self-employment, go, are you going to buy the house soon? And have you actually stepped off the bridge into self-employment? Because it might be easier to get the home loan before you do that. So that's step number one. Step number two is if you're going to do it, then you know, I would like to recommend that people get with their accountant early and start talking about what these tax returns are going to look like if you're planning on buying a house. Because if you can get one good tax return, you got a chance to maybe getting a little bit early on the approval process than 2 years, depending on what we're all talking about. So self-employed people that want to buy a home in their first years of business, get with the mortgage person, get with the accountant. A lot of times the solution is in their spouse. If they're not making any money self-employed, their spouse is, and there's a way, you know. But yeah, get the picture on the table, talk to people, because once you get a certain distance down the road into self-employment, you might box yourself into a corner where you're 2 years from getting a home loan. So the best thing to do is to if you have the ability to check in, figure out what's going to happen. As a self-employed borrower, I don't want to pay a lot of taxes. Is that just a self-employed borrower? Okay, all right. And I write off everything. Oh my gosh. But can I still get a mortgage? So that borrower is the last two scenarios that we just talked about. So, and here's where I've seen this a lot, but I've seen this in like bar owners, and like they apparently can cash flow like crazy and not make very much on their tax return. Just the ones that I've seen. They can get a loan by showing that cash flow to the lender. So I guess the question is, if you're committed to not paying taxes and you're doing it legally, there are lenders out there that are willing to lend to you. They want a little bit more down payment. And so my advice is don't be committed to that. Just try to run a nice business where you make so much money that you do owe a little bit of taxes, and then it's easier to qualify you. Sometimes the interest rate is affected. These alternative products tend to be higher in interest rate by maybe 1% over what you can get in the best scenario in the marketplace. Okay, here's a good one. This happens a lot. I've just started my self-employed business, but I'm also working a side gig and getting a W-2 that's enough to qualify for the mortgage. Is this going to be a problem? Yes. So the problem is, if you were just working a job and then you go start a business, we're going to have to reconcile the fact that you might not have enough time to do both. So it might sound great that you have two jobs, but if you've never done it before, so it depends on what it is, but oftentimes having two sources of income requires a little bit of time to prove whether it works or not. So it doesn't necessarily solve the problem of entering self-employment to hold down a full-time job and then also start a business. Probably the best thing to do in that case would be to get with your mortgage person, your accountant, and determine when does this business have to actually be recognized on my tax return. Because if you're not making any money in the beginning, it might make sense just to keep your job, and then people tend to not file their taxes for a year or two, so that you might be able to be doing both things at once and not have to make a big deal about it. So that would probably be the solution for that person. Okay, we're going to wrap up on time, and we've got a few more minutes. Okay, good question. So I started my business in 2020 and filed a great tax return. And I have a even better looking profit and loss statement that I've prepared. Does that profit and loss statement make me look better to the lender? And the answer is no, because it's not filed with the IRS. So one of the things is we do have you or the borrower let us know what you're making in the year that wasn't filed with a tax return. And the only thing we're doing with that information, there's only one thing, is we're just making sure that you're not going to tell us that you're now making less. So if you're filing your own profit and loss statement to the lender, so if you were buying a house right now, we would be looking at your 2020 tax return, and then we would ask you to supply a profit and loss for the year 2021. If you provide me a profit and loss statement that says you're making dramatically less this year, your loan is declined. And it hasn't been filed with the IRS, and you told us that. So that's a self-stated scenario. So if you're going to make the money back in the last month of the year, you might want to give us the best case scenario, because we're going to take your word for what you said on how much you're going to make this year. This year is not going to get audited through our normal analysis. We just need you to tell us what you're making. So the added income won't help, and if you tell us you made less, it'll hurt. Here's somebody who says, I make commissions. I don't technically own a company. Do I need a full 2-year history to get a loan? So this tends to be 2-year only. So when you own the business, you're actually in a slightly better scenario than if you're just getting commission from an employer. Best thing to do if you're in sales is, if you're going to jump into sales and you're going to become an auto salesman tomorrow, get them to agree to pay you a fixed pay for a period of time so you can go buy a house. Because if you're going to go walk over to the car dealership and go, I'm going to get paid every time I sell a car, that's the hardest one. That's 2 years all day long. They never give you an exception on that. With this one exception, if you've been selling cars your whole life and then you just go from Don K over to Eisinger, we can give you an exception on the 2 years sometimes if it looks like it's holding up under the new employer. So bottom line is, commission salespeople, that's the hardest form. And again, I would say if you're getting ready to do it, there are ways to mitigate the 2-year waiting period. But once you've done it, if you go to work full commission, they need to see that for 2 years, because that's deemed to be the hardest one to prove your ability to succeed in until you've done it. I've got all the questions answered. Anybody else want to go real quick? Well, thank you. And next month is how to go from $0 to millions of dollars in the playbook. So thanks for joining in.